Let's talk about one of the biggest questions in all of finance. It's a puzzle that's launched thousands of theories, made and lost fortunes, and it might just have an answer that's been hiding in plain sight this whole time. I mean, really, why is it that some stocks just seem to win? Year after year, they generate higher returns than others. For decades, we thought we had a simple answer. But as you'll see, the market kept throwing curveballs, these strange behaviors that the dominant theory just couldn't explain. That is, until someone decided to flip the whole problem on its head.
Okay, so before we get to the revolution, we've got to talk about the old guard. For a very long time, the reigning champion of how to price stocks was a theory that was all about one person, you, the investor. It's called the consumption capital asset pricing model. Yeah, it's a mouthful, so let's just call it the consumption cap. The idea is actually pretty elegant. As a rational person, you want your life to be smooth, right? You don't want big swings in what you can afford to buy. So, a stock is risky if it tends to do badly right when you really need the money, like during a recession when your own job might be on the line. So, the whole idea boils down to this: to get you to buy one of those risky stocks, one that might just tank during the bad times, it has to offer you something extra. A higher expected return, a little bonus for taking on that risk, more reward. Makes sense, right? It's intuitive, it's simple, and for a while, it seemed to work. But the real world is messy. And when researchers really started digging into the data, they found these patterns, these persistent, nagging patterns that this simple risk story just couldn't quite explain. They gave them a name: anomalies. For instance, there was a value premium. This was the wild discovery that cheap, boring value stocks were consistently outperforming the exciting, glamorous growth stocks. Then there was momentum, the fact that stocks that were winning tended to just keep on winning. And the investment effect, which showed that companies that invested a ton of money actually tended to have lower returns in the future. According to the old model, none of this should have been happening so reliably. And this basically broke the finance world in half. On one side, you had behavioral finance, which said, see, this proves investors are totally irrational. They're driven by emotions and biases. But on the other side, the efficient markets camp fought back, saying, no, investors are perfectly rational. It's our model of risk that's wrong. It's just incomplete. All right, so that's where this new idea comes in, a total flip of the script. Instead of just focusing on what investors demand from stocks, what if we looked at what companies supply to the market? This is the core of the investment cap model. Now, what's so cool about this is the shift in focus. We're no longer talking about investor psychology or what you're buying at the grocery store. Nope, we're looking at the cold, hard decisions that managers are making inside the company. How profitable are we? And based on that, how much should we be investing in new factories or projects? And the best part? The logic behind this isn't some crazy new math. It's literally built on one of the first things you learn in any business class: the net present value, or NPV, rule. A company only takes on a project if it's going to make more money than it costs. Simple as that. Okay, stick with me here because the logic is really beautiful. Picture a super profitable company. You'd think they'd be investing like crazy to grow even more, right? But what if they're not? What if this really profitable firm is barely investing at all? Well, the only rational reason for that is if their cost of capital, the return they have to promise to their investors, is incredibly high, so high that even good projects don't look profitable anymore. And here's the punchline: a high cost of capital for the company is exactly the same thing as a high expected return for you, the shareholder. It's literally two sides of the same coin. Now, a theory is great and all, but can you prove it? Can you actually test it? Well, yes, you can. When you translate these core ideas of investment and profitability into real measurable things, you get something called the Q-factor model. So let's put it in the ring, head-to-head with the other heavyweight champion, the famous Fama-French five-factor model. Now, at a glance, they look pretty similar. They both use things like investment and profitability. But the real question is, which one is more fundamental? Which one truly explains what's going on under the hood? And wow, this chart right here tells the whole story. When you use these new Q factors to try and explain the returns of the famous Fama-French factors, they nail it, almost perfectly. There's basically nothing left unexplained. But, and this is the key part, when you try it the other way around, the Fama-French model just can't explain the Q factors. It's a one-way street, which tells us the Q factors, born straight from economic theory, are the real drivers. And the performance is just stunning. The researchers threw everything at this model, 35 of the biggest, baddest market anomalies that had stumped everyone for years. And the result? The model's average unexplained return per month, what they call alpha, was just a tiny, tiny 0.20%. It basically explained away decades of market mysteries better than any other model out there.
So, what's the big picture here? What does this all add up to? Well, this isn't just about a slightly better model. It's a complete rethinking of what drives stock prices. It's what the author of the paper, Lu Zhang, calls a full-blown counter-revolution. I mean, just listen to that. That is a powerful statement. For years, the story was that all these market anomalies were proof that investors are irrational and markets are broken. This new evidence comes along and provides this incredibly robust, logical framework that says, no, the market is acting exactly as it should. So here's the big takeaway, the whole point of this new perspective. Those weird patterns, the value premium, momentum, all of it. They're not glitches in our collective psychology. They're the predictable footprints left behind by rational companies making smart investment decisions based on their own profitability and their own cost of capital. And that leaves us with a really fascinating thought to chew on. Maybe we've spent all this time searching for quirks in the minds of investors when the real answer was right there, on the other side of the coin, in the simple, powerful, and perfectly rational economics of the companies themselves.